the Fed has announced, 7 times they're going to increase rates. Should I start to move away from growth stocks and lower maybe my growth stocks to value stocks in my portfolio?
Yeah, I think a couple things are there that are important to unwind. The Federal Reserve has this dot plot. It's their guess as to what they'll do. So far, the dot plots have been going up. It was one increase, and it was 2 to 3, 3 to 4. Now it's 7, and so theoretically, if you watch those dot plots, the guesses are going up. It doesn't mean they're going to even do 7. There's other things that can slow things down, including the situation in Ukraine or even the situation in China with the lockdowns, which is basically a pandemic related slowdown. So there are things that can slow down the economy besides these rate increases. So we might not have them. Always keep that in mind, because all they're doing there is guessing. They're going to look at the data at each meeting and decide what to do. But let's assume they are going to raise rates, and we're going to continue to raise rates, and rates are going to go up for quite a while here. Historically, during the rate increase period, stocks do well. It's not until the end of cycle, beginning of cycle, which is where we are now, stocks do very well. Theoretically, actually, you start to see more gains out of interest rate sensitive stocks like banks and those types of things. Um, but I would be a little bit careful there. First of all, I'd probably have a balanced approach with most of my portfolio, which is what we do have, a balance between the growth and the value. But if you're looking at, where are you going to target as far as that goes, this week, what's been running? So we just increased rates. We've talking about increasing rates even more. Growth has been the huge, huge winner this week. I mean, monstrous winner. And so there's a couple of reasons for that. Number one, a lot of these companies are already down. So if you're looking forward, maybe Microsoft, which we bought on a dip, was down 20% when we bought it. That's a pretty big dip for a big company that does unbelievable things, has huge cash flow. Apple's been down from its high and all these things, but the smaller growth stocks that really ran in 2020, peaked mid-February of last year. Those are down 40 to 80%. The Kathy Wood type ARC funds and those types of things, man, are they flying right now? But they've already sold off. And so you are getting some discount there. Some of them might still be selling for more than they should, but there's an interest. These companies are really the future, and they have high growth, and they might be selling for a lot, but there's a lot more interest in those companies. Like, for example, genomics, right? It can change the whole medical world, could solve cancer, delivery of different drugs. Genomics is really responsible for the vaccine, the mRNA vaccines. That's a lot more exciting to people than buying a bank stock because interest rates are going up. And so I think you got to be careful of going too far away from the growth stories, because every time they report earnings, it's fantastic. I mean, unbelievable. Especially, the Microsoft and Apple's of the world. Like, wow. I mean, they just keep coming out with all of these pieces. So I'm actually more inclined to be on the growth side than the value side here. I think growth has already sold off a lot. There'll be something to be made. The ARC, you were telling me today, the ARC KK fund for the week is up, what, 19%?
Yeah, it's pretty ridiculous.
That's ridiculous. Now it was down like a massive amount before that happened, but they're buying it, right? They're coming in and kind of buying on this dip and such too. And so we're seeing, growth stocks do well. So ironically, I think it's already happened. We've already seen the sell off. And now the place to be might be growth, even though rates are coming up, just because, again, that's where the sell off and the sizzle excitement is too. So I don't know. I'd still lean towards growth. We keep a very good balance on 75% of our portfolio between growth and value by basically buying the whole market. And then we have this targeted indexes that we use. And right now, that's 3 out of those 4 indexes are in growth pieces: semiconductor index, Microsoft and Apple, for example, which I still really like. They've had mixed results so far, but I think going forward we have some really good chances there.
Yeah, I mean, we've always talked about how you shouldn't try and guess what's going to happen, but try and react. And so
Mhm.
by guessing that there's going to be a lot of rate increases and moving away, you're kind of trying to jump the gun here, and
Yep.
you don't know what's
Yep.
going to happen really.
Yep. Yeah, I mean, people loaded up on all these financials and such, you know. I'm still thinking that there's some better opportunities out there, personally. Nothing wrong with that as part of the overall portfolio mixture, but in terms of, you know, moving away from growth, boy, you'd sure be going the opposite direction of the market right now. There's no doubt. I mean, this thing is flying. I'm watching it right now. The S&P 500 is now up over 1%, 1.05. It's approaching the 200-day moving average. It just blew through the 50-day moving average. This is a melt up right now. I don't know if it'll continue. I don't know if it'll melt up all the way back to the highs that we set back on January 3rd, but it is really, really strong. This is not your little jumps that we've had so far this year. This is much different. This is an important week for the stock market.